Hello, I'm Steve McClellan, the financial engineer, owner of Design Your Future Financial Services, and proud member of the IB Canada Group, where we show you how to grow, control, and protect what you build instead of giving away to taxes, fees, and the unknown. And over the next 5 to 10 minutes, I'm going to show you exactly how to do that, regardless of the decisions the government makes, inflation, or what even happens to the stock market. And yes, I'm going to talk about the infinite banking concept. For those who have never heard of the infinite banking concept, one of the best definitions I've come across is this gives you the ability. This is a process, a system, a way where you can recapture the interest that you normally would have given away to the banks or other lenders and still buy the things you want. It really helps you recapture that opportunity cost. Instead of the money leaving you, you have it and have access to that true compound growth year after year, where you can become your own bank. It's pretty powerful. And the way this is set up, when it's set up properly, it uses a properly structured dividend paying whole life policy. And I'm going to spend the next 5 to 10 minutes showing you exactly what a properly structured dividend paying whole life policy is. Listen, to be crystal clear, very few financial professionals even talk about whole life. And then very few, I would say the 10% of the 10%, even talk about how to set it up so it's efficient and effective for you, not for the advisor, not for the institution. And I'm actually going to use my very own policy to show you the difference between a truly properly structured dividend paying whole life policy versus what the majority of the financial professionals do out there. All right, so let's get started. So let me cover up my pretty face here. See you later. Get out of here. Go to the corner. Yeah, there you go. And again, this is my very own policy. And with a properly structured dividend paying whole life policy, there's really two parts to it. There's the insurance part, and then there's the part that you can use while you're living. And as you can see, I have a whole life, 100,000 policy. So when I die, and I hate to be the bearer of bad news, we are all going to die sometime. So no matter when I die, at least 100,000 is going to go to my loved ones at an annual premium of $1,979. And what's nice about this is flexible. This is a very flexible policy. So I can actually have my policy pay for itself. I do not have to pay this out of my own pocket to the age of 91. I can set it up so the policy pays for itself. I also added a $1 million term rider for the next 10 years at a premium of $841.92 for the next 10 years. That gives me the ability to put in $44,194.97 into the deposit option. Now, this is the portion that I can use while I'm living, and this gets the dividend. Now, the dividend is not guaranteed, but it's the closest thing to a guarantee that I've come across in the financial industry. And what's nice about this, it's vested. This means it never goes down. It gets that true compound growth year after year, not like the market that's up and down. So what do all these numbers mean? So let me show you. And listen, folks, I know there's a lot of numbers coming your way, and I know it's hard to read, but let me go through these. So what this means is, being a very flexible policy, I have the ability, the minimum amount that I need to put down is the cost of insurance, which for the first 10 years is $2,821. And then after year 10, it's $1,979. And again, I can set this up that the policy pays for itself. This does not have to come out of my own pocket. And as you can see, there's no surprises. It's $1,979 all the way to 91. No ups, no downs. What this does is gives me the ability to put in $47,016 for the next 20 years. This includes the deposit option that we talked about. And if you look at the numbers, after year one, this gives you a cash value of $43,381 and a death benefit of $1.25 million. So I'm a very numbers guy. And if you're anything like me, you're saying, Steve, if I put 47,000 in At year one, I'm going to have access to 43,000. That doesn't seem like a great deal. And you'd be right. The break-even point in this policy is year three. What's happening is the cost of insurance is coming out, the cost of underwriting and commissions. But as you can see, it's getting that true compound growth that's vested, that grows very tax efficient. And then after 20 years, at that magical age of 65, there's a cash value in this policy of 1.6 million bucks and a death benefit of almost 3.4 million. Let's compare this to an RSP, folks. If you needed access to that 1.6 million bucks and it was in an RSP, guess what? Right now, today, at least 50% is going to go to the government. You get to keep the other 50%. And do you think taxes are going to go up or are they going to go down in the future? What's nice about this, you have access to 100% of this. There's three ways to get it. There's obviously, you can just take it out directly. You can use what's called a policy loan. That's using the insurance company to borrow against this, or you can use a bank loan. You have control of this. You have access to it when you need it. And if I show you, if you live that long life at 100, this gives you a cash value of 3.8 million and a death benefit of 3.8 million. Talk about leaving an awesome legacy. So what are the other financial professionals doing out there? So let's compare. Now this policy is actually done very well as well. This is close, is as close to as efficient as the policy I just showed you. A lot of it, financial professionals will even make this more insurance heavy. But as you can see, for the same annual premium of 47,000 for the next 20 years, the cost of insurance for the next 10 years using this policy is $12,346 compared to the $2,800 I showed you. And then after year 10, it's $11,486 till the age of 100. Now, why I show you this, this is the cost of insurance. This is the minimum that needs to come down. We all know that life happens. There should be no problem being able to afford the 2,800 year after year, but maybe once in a while, having to dish out 12 grand could be a problem. And the other thing with this policy is there are more rules and restrictions to it. Maybe that's a description for the other time, but let's compare it. Actually, let's compare them side by side because there's some cool things here. So with the more efficient policy, the break-even point is year 3, where here the break-even point is year 9. At that magical age of 65, the more efficient policy has a cash value of 1.635 million bucks and a death benefit of almost 3.4, where this policy has a cash value of 1.47 million and a death benefit of 2.8. So you can see this is more efficient. They're both great policies. Actually, this would be good. This would be considered great. Where this really takes off is if you live a long life, you live up to age 100. Look at the death benefit of this. It is 6.5 million bucks, almost 6.6 million compared to the 3.8. So if you are more concerned about living that long life and leaving a legacy, this might be the policy for you. Otherwise, the more efficient policy while you're alive is the one that I showed you at first. But what I love about this is being independent, we can do what is best for you, not what's best for the institution, but what is best for you. So what is even more important to you, we can do it. Now, I realize the numbers are small here and I threw a lot of numbers at you. If you want this presentation, I'll be happy to give it to you. Just reach out. What I want to do to make sure that this hit home is to show you that this is another way for you to create wealth. A truly diversified portfolio has several different ways of creating wealth. Obviously, there's your business or your source of employment. There's real estate, investing or saving, and this could really replace your investment portion, at least your fixed income portion. Great way to get your money to work hard for you and to make sure that it's there when you need it. Those that are business owners realize that living benefits can be very beneficial, especially if anything happens to you, to protect your income and to keep the income coming in. I'm the expert when it comes to becoming whole life and becoming your own bank. And of course, there's the home runs for alternatives. So to make sure that this hit home, I got to ask you, if you look at these different ways of creating wealth, what is your number one wealth creation? And I hope you know the answer, that you are the major key to your success. What the policy does that I just showed you, it complements all these other forms of creating wealth. And what I really like about it, it stops you from chasing all these squirrels. It allows you to focus on what's important to you and to double down on your strengths. So it's really a way to complement everything else. If you have any questions, please reach out anytime. You can reach out to me personally, or you can reach out to the good people of the IB Canada group that can be found at ibcanadagroup.ca or .com, both work, or simply reach out to me. Until then, be healthy, be wealthy, be wise, push through the noise.